the marijuana space. This stock went up 1,000% in 28 days. It came right off of a low cheat. And that was your opportunity. You had a couple opportunities to get on board right off of that low cheat. So here's a BDSI. Again, here's your first buy point, and then you get another buy point right here. These are those multiple buy points. Sometimes I'm gonna fast forward just over one here to just here. Sometimes they're more creative too. This is a real creative a low cheat. And again, see, same principles though. The volume, see how it dries up, and then the volume comes in. And same thing here, you tighten up a bit, volume comes down, you get the 1-2 punch, right to over here where you get the little, there's a little mini fractal, 1, 2, 3, 4, 5, 6, 7, 8, 9 days. Even on a 9-day time frame, look how you get a little VCP. Those are fractals, patterns within patterns. That's what makes it so strong. All right, so with what you've learned so far, the question is, would you be buying here? Is this a proper setup? And we don't have an audience here, a live audience, where or an audience that's can respond right now. So I'll let you answer that, and I'll give you the answer. The answer is absolutely. Not only is this really a perfect setup, it is a cheat area. You actually had a low cheat also. I think it's right here. There we go. Page 206. You had a little low cheat right here, where you could have bought some there and then actually add it to your position right here. Or if you passed on this one, then certainly you could have been buying here. But again, look at the explosive nature of this. In 14 days, it goes up 100%. It's no coincidence that you're getting these volume bars on the upside in big contrast to very, very light volume, because that's the supply demand picture. And that's what you're going to be trying to achieve each time that you go into a trade. You want to go in there when the supply is low and look for those stocks that can have very explosive price action. Now, what we're doing here is we're waiting for a change in intermediate and short-term trend to get back in sync with the long-term trend. So we already know that, everything I just showed you with these pivot points, the low cheat, the handle, what that's accomplishing is that you're not just trusting a broken downtrend. All right. If you were to buy and just draw a line, you can go back into the into standard technical analysis and draw trend lines and so forth. It's not very useful. It's not very useful, because the problem with drawing a trend line and having the trend broke, what happens is the stock will redefine the trend. So it'll break the trend, then make a new low, and now you got to redraw the line. And then it'll break the trend and make a new low, and then you got to redraw the line. And each time the volatility widens and widens and widens. So when a stock is correcting, the most volatile period is usually around the bottom. So that's where you'll get it making these big whipsaws back and forth, and you'll just keep redefining the trend. So what we found is that another problem is it doesn't take time into account. It doesn't allow the stock some time to stabilize and to prove itself that it can start moving up off the lows. Again, we don't want the lowest price. We want the right price. So we want to see some stabilization. Now, the stock's already in an uptrend, right? I know I've said that 15 times already, but I'm going to keep saying it. The stock is in an uptrend. Now you're in that correction. What we want to do is we want to time getting back on that uptrend, coming out of that intermediate term downtrend, but we want to make sure that we've got the symmetry, that the stock has had enough time to go through that natural wringing of the supply, getting the water out of the towel. So to do that, we want the minimum that we want to have the stock require is that it marks itself up, pulls back, and then is able to take out the high from the pullback. And that's what I call it making the turn. All right, where the stock has made the turn. And sometimes you can have a pivot even below. You'll see in those charts where there's a pivot and it's below the turn, which that's getting in a bit earlier. That's like the low cheats, and sometimes you can get in before the turn. But that breakout from that pivot would cause the stock to make the turn, and that tells you that now the stock is now in gear with the longer term trend, because now the shorter term and the intermediate term, all the trends are in the same direction. That's what you're trying to accomplish. Now, talking about giving the chart time, we're not going to just guess. All right. There's ways of looking at this. And one is what I call time compression. This is another term or form of analysis that I've invented, if you will. I've actually never heard anybody talk about this except me, and I've probably been talking about this now for well over 20 years. But time compression is, just think of if you had an unsymmetrical U or V, or if you were to have a chart and then you were to push it and squish it over. So now it were to look like this, right? Versus here, we have that right side, those fractals, that tightenings. See, here, there's no tightening. There's no tight. You're in the most volatile phase right here. So we don't want to trade around volatility. We want that volatility to subside. And then once the volatility is quieted down, we're looking to get over here. Again, not the lowest price, the right price.
Mark, just to highlight too, that last slide, this is a classic one to kind of cement in your head, because the left example is what I see a lot of rookies and amateurs doing, meaning they're buying right where it says no there is usually where they're buying, because a stock or is moving up and it just looks like it's going to go to the moon and it sucks in buyers. And then guys like Mark and myself are waiting for that right hand example, and often on the backs of the less disciplined. They're getting rinsed out and rinsed through in that process to the right. And if you can really learn to understand and master this concept, you'll guarantee that you'll be in situations that are far more repeatably explosive.
So I often say that when you're, and this is a paraphrase of Bill O'Neill. Bill O'Neill said this. He said, when you're doing nothing, those that are less skilled, those that are less disciplined, are laying the groundwork for your success. That one sentence literally made me a multimillionaire. That I took that sentence to heart, and when I finally realized what that meant, it was worth a fortune to me, and I always pass that on. And this is one of those times where we're going to look at what not to do, but the way we're going to do it is we're going to look at what not to do and contrast it. Okay, because what happens is what not to do usually occurs before what you should do within the same chart. And this is exactly what Mark's talking about, where you'll have an amateur will be buying the stock over here as it runs up here, and it's not sustainable and hasn't gone through the VCP. Now, let me just say this. It does not mean that a stock can't just shoot off the lows and take off. That happens all the time. All right. There's definitely stocks that will take off. Not every stock is going to go through a VCP before it makes a big move. However, as we pointed out earlier, we have to have reference points, because when the stock's in no man's land and I don't know what it's supposed to do, I don't know that train's supposed to come in at 6:05. So if it comes in at 8:15, 8:15 doesn't mean anything to me because I don't have the reference point. So we've got to have those reference points, first of all. So when and on top of it, this is based on not just my own my own idea of what should happen. This is based on going back, looking at all the biggest winners. When did they start that big move and that velocity portion of the move where you got the alpha and the volatility was low and the upside was big and the asymmetric leverage, you could time that asymmetric leverage. Where did that take place? Well, it took place once the stocks went through these iterations, and that's where the risk was the lowest, because this is the law of supply and demand. Now, again, you certainly can have a stock that just takes off the lows, but it has to be something that can be repeatable. Can you identify it, and can you take advantage of it regularly and manage your risk in relation to reward? Those are the real questions. Not does it happen? Okay, it happens, but can you identify it, and can you utilize? Is there a strategy that can be built around it where you can do it not only over and over consistently, but year after year? And that's the difference. This is timeless. What I'm showing you is timeless. So here, this is not, you would not want to be buying this right here. Okay. Now as you go through the iterations, actually right here, see, look right here, there's a little tiny little VCP right here. So you actually have a low cheat right here. Then you set up here, you have a little, look at the little VCP. See a little tightening, you can even call it a little cup with handle. See, that same little pattern is going to happen over and over and over. And you want them to string themselves together and get to a point where you see right in this tight area, look how low the volume is. Right there, the volume's really low. I would actually started buying right there, 1, 2, 3, 4 days prior, and then maybe even add it to my position. 1, 2, 3, 4, and there you go. You're set up. Let's take a look here at Troy Group. Look at Troy Group here. See, it runs straight up here, but it's not enough time yet. It didn't have enough time to build out that right side and to really tighten up. And now, where you spend that time, you put in that time. There's no compression now, no time compression. You've moved out the right here. You've gone through a number of iterations. See, the volume comes way down. Look at the contrast in volume. Look at that volume the day before it unleashes, and look at the volume the next 2 days on these explosive bars. That's not a coincidence. I know I've said that 5 times now. I want to say it a sixth. It's not a coincidence. All right. There's a reason behind that, and it's identifiable. All right. 146% in 14 days. How'd you like to have a couple thousand shares in that? All right. So now, sometimes it's really the contrast between the compression and the correct buy point is incredibly obvious in hindsight. At the time, this might be on earnings, I don't know, some announcement, and you get all excited about the stock, but you got to revert back to the chart and have it temper your enthusiasm and make sure that the stock is setting up properly, and you got to have that discipline to wait and to wait. If the stock just takes off and blast off, you got to let it go. You got to let it go, and you just got to pass on it. Mark, you are as good as anybody I know at passing on trades and waiting for, I mean, you are like the tiger in the brush waiting for a little baby antelope that's lame. I mean, you're not even you won't chase anything unless the chances of success are really, really high. So I would defer to you to how do you do that? How do you keep that discipline?
Well, yeah, one of the things you alluded to this earlier, in terms of your reference points, and this chart right here, too early compressed right side. If you buy right there, if I do that type of buy 1,000 times, I have absolutely no confidence. I mean, I have confidence I'm probably money down, certainly not money up, because to your point, it has not gone through the proper process. So, I tend to be a creature of habit. Little wins lead to big wins, little successes to big successes. So if you buy though at the correct buy point here, it doesn't guarantee you're going to be right every time. But if I buy there 1,000 times, I'm not just ahead, I'm way ahead. So I would much rather wait, and there are no called strikes in this game. It's not like playing in a poker tournament where there's blinds or whatever. You can wait. The problem is, to your point, is that tends to test your personal resolve and discipline and those other things, which we'll get into later. But I just think about it in terms of, I'm always asking myself, if I did this 1,000 times, where would I be?
Right. We're looking to play aces, kings, queens, premium hands. Just like in poker, we want to play premium hands. The difference is, in poker, you're in a poker tournament, they raise the blinds. You're forced to play inferior hands. Otherwise, you get eaten up with the cost of playing the game. Well, you don't have any with stocks. You don't have any cost. You can sit and wait and wait and wait, and only play aces. So how could you lose if you played poker and you only played aces and you never had to put up any money? I mean, the only way you can lose if the other players, so this guy only plays aces, and they adjust their play for you. But that doesn't happen here. So now, just going back to this chart, some would look at this and say, well, this is a VCP. It tightened up right here. But again, there's time compression. It's too short on this right side. You haven't gone through those iterations. So while you could try this, and in some cases it might work, if it's really, really, really strong, and there's this, maybe some surprise news that came out of nowhere. But like Mark just said, if we buy it here, coming out of this little short right side, versus buying it after, let's just say we bought 100 stocks that look like this and 100 stocks that were short, the 100 stocks that have the better formed right side are going to absolutely outperform the others. There's no doubt.
And I don't know, Mark, I'm guessing you would agree with me, but it does seem like this is an area a lot of people struggle in, especially early on, or we see lots of people calling things a base where it's 2 or 3 days, or everybody wants to get in, after just a couple of days rather than
Yeah.
giving it that time. Again, if you put all these things in context, we're trying to give the stock, the time to go through this natural process of contracting and tightening from left to right.
And that comes from two things. One is a lack of experience, that you just don't yet know what to look for. And that's why you need to use these precedents. This workbook is priceless for that. So you should be looking and comparing and using the precedents and looking at current charts and comparing them. And you'll start to see there's these similarities. The other reason is the eagerness to get in. You want to buy. So you've got this eagerness to get in and play the market, and that can really be, that's a form of FOMO. So you got to get really disciplined and mechanical with this, where you wait for those setups. You let the stocks. I often say I don't pick stocks. Stocks pick me. I just watch them, and then when they get to the point where they meet the criteria, then I put my buy order in at that price when it goes through the pivot. And I let the stock tell me which stock I should be buying. And the first ones that move through that pivot, those are the first ones I buy. I don't even have favorites. And okay, this one looks better than the other one. There's basically a baseline of criteria that has to be met. And when it meets that, whichever one starts moving first, I get that first mover advantage. So you want to let that right side develop. So you got that downtrend, you break the downtrend. When you get that first pullback after you break the downtrend, that's where you've made the turn, and that's where you can start buying, because that's where now you're back in sync. You're back in sync with the longer term trend. Here now, one last thing. We talked about deep corrections. Now we have to be careful because there's a lot of overhead supply, right? So when you get that deep correction and you couple it, this is where we a really dangerous situation. You get a deep correction and you get the compression. You get the right side compression where it runs straight up the right side and doesn't go through those iterations. You get into a very, very dangerous situation where you can come crashing down very quickly. Here's a stock. This is Travel Zoo. I remember this really well when it was setting up, because there was a bunch of people saying, oh, this is a cup with handle. This is setting up perfect. And it wasn't perfect. It wasn't perfect at all. First of all, you had the stock off 50% when the NASDAQ was only down 10% during the same period. So it was already showing tremendous underperformance. Then it ran right up the right side and had a compressed right side. It did, for having such a big decline in such a short period of time, you needed time to weed through that supply. You had to go through those iterations, because as you're going through those iterations, that's telling you that supply is being absorbed. It's telling you that there's some strong hands. Like each time it tightens, it's saying strong hands just absorb some supply, because now it gets tighter, which means that there's less supply. If it got wider and it started trading all over the place and volume went up, well, that would mean that the supply wasn't absorbed. So you got to get that evidence, and you don't have that evidence here. And sure enough, this came out here, and 3 days later, whoever bought that breakout woke up with a very sad morning on that gap. So it just comes crashing down, and that's due to all that supply. Okay, now I want to back up a little bit. What we're going to start looking now a little more forensically. This is sort of like we just looked at like a fingerprint, and we looked at the whole thing, and then maybe we looked at the tip of it. But now I want to go within the fingerprint and start looking for some of the things that you want to see within the base. And again, one of the reasons, or the evidence that we have some demand, because again, we're looking for that tightness in price, the low volume, to determine that supply has stopped coming to market, but we still need demand. So one way that we know there's some demand is because it's in a stage 2 uptrend. It's in an uptrend, you've got that inertia, but we want to see something more immediate, something that's closer to that buy point that's going to develop. And that's how the stock acts around the lows, coming off the lows, coming up the right side. Down the left side, it could come down crashing on big volume. That's fine. It's correcting. The volume's coming. They're selling. That's clearly where they're selling. There's a lot of supply and they're selling. But when you come up the right side, and very often this will happen on news, and somebody might buy the stock. Some people buy the stock on the news, but the news has to also meld with the chart. Okay. And very often the news will come out and then you'll get that setup later on. It'll take a little time. You'll get that post earnings drift, but you needed some time again to weed through and weed out some of that supply. So this was a perfect example. This was Dick's Sporting Goods. I bought this over here. We're gonna look at this later on, but I bought this right here on April 1st, 2003. But what got my attention, it was setting up here and it was tightening up right here. And then it came off, it fell apart and it looked like it was curtains, but they upped guidance and the stock just exploded on a gap. And then from there, it just started staying quiet and it got really tight. So, and this is an IPO base. It's a recent IPO. And with IPOs, we have a whole section on IPOs. I'm going to talk about that later. But with IPOs, you may not have enough history, price history, to be in a stage 2 uptrend. So now you're just looking at the price base itself, and you'd like it to be in some type of uptrend. You can maybe use the 50-day, but sometimes you just have, like right here, you just have a very short amount of price action, and this was buyable right here. This is a smaller base, but you can see same thing applies. Tightens up right here, and bang, comes right out. I was looking at it over here after they upped guidance, and you had that nice response when it tightened up, and it really tightened up on this right side. That's where I bought it right here. Let me show you a couple others. So even with this one that we just looked at before, that was massively compressed on that right side, look at the huge demand. So that's telling you that there's big demand. Now you just need to wait and get yourself on board on a low risk buy point, which you need the volatility to calm down. You need the stock to calm down. And again, that's going to probably happen, or very often it's going to happen at a higher price. We don't want the lowest price. We want the right price. Here's another VCI. Shakes out the low. See, right up the right side. Look at the big volume up the right side. But see, that's not where we're going to buy it. We want to wait till we get that right side development. Once it develops that right side, you can start buying some here. And then you really start to tighten up quite nicely right here. You see low volume, and there's the 1-2 punch. It comes out, and then you get the gap. The next day is probably going into earnings, though. I don't remember that one. This was Elan. I bought this. This was back in 1990, going to 91. You've had a very large up day, big volume, and see now you get the right side development, and then look at that tightness right there. It's 1, 2, it's like 3 days. Look at the volume. So it comes way down. 2 days before it breaks out, it's some of the lowest volume in the entire history of the stock during that last year or so. Again, looking back at this was Cirrus Logic. Now, here's another situation that happens very often where a stock runs up an anticipation maybe of an earnings report, or the company might even raise guidance. It's a surprise, and it runs up and it's way extended. There's no base whatsoever, so you wouldn't be buying it here. But I take note of that. All right, if that can hold relatively well, especially I look for those stocks that had good news. They blast it off, and then the market corrects. So now the stock comes in because the market's weak. That's exactly what happened with Cirrus. This is how I got on board this name. They raised guidance, stock blasted off, great response to the news, but the market corrected. The general market started correcting. But as soon as this stock came right off the lows and started forming buy points, so that's where this is the one that I blogged. Again, same thing with AMSC. See, up the right side here, I would never buy here. This stock is very risky. There's no base. It's extended. It just came on a big gap. And now, look, it takes all this time to correct. See, if I'm buying it here, again, ultimately, I may be right. If I want to take the risk of holding a stock, buying at $13, $14 and holding it down to $9 and being at a 40%, a 50% loss, I'm not managing risk very well, am I? So and going through now 1, 2, 3, 4, almost 5 months and a 50% decline, that is not going to lead to big returns. That's going to lead to blowups and wasting a lot of time with dead money. So I make note of this, right? Had news, great response. Now it goes through the VCP and you get that nice pivot. This is where I want to be getting on board, right there, just as it takes off and on the launching pad. So again, here, look at the big demand here. This was workday. There's got a few examples here that are a little more recent. So again, 1, 2, 3, 4. Here's your tightenings, right? And everything's culminating to that buy point where it comes out and you get at a profit right away. But look at that big volume and that big move off the lows. That's that demand. That's what I want to see within the base. Sometimes you'll get it in a number of areas. Okay, you'll see here it comes up here, and you got some you got some demand right here, right off the low. So you're getting support around these lows, but it's just not time yet, right? Yeah, it hasn't gone through those iterations. You haven't gone through those tightenings yet. But then when it finally tightens up here, you see if you just draw a line from that last tightening, that buy point, you could even move this down right here. That's actually fine right here. Whoops, sorry about that. Move that down right here. That's tight enough right there. Just a couple days, and you can start buying right on that day. I think that's actually where it was supposed to be. And again, this was Garden Central CENT. If you draw a line from the pivot point, you see how almost all the price action is below that point where the pivot's setting up. The supply is way to the left, and it's only traded above there for just a little while. So minimal supply, minimal trapped buyers now, and you've had all that
to
time.
Point out, it's far left. This is where, to use David Ryan's old, just draw a line for those of you guys, starting. Keep it simple.
Right.
If you've got a lot of stuff above that line in the past week or 2 or 3, it's probably not ready. But, if you see some, this is going back now, what, 6, 8 months, but even then there's a very little bit. So the minute you trade above that, you're clearing all of that far back to the left out.
Yep. Same thing here. When you look at Cenacorp, again, see the demand right here. You've got some strong demand here, but it's not ready yet. You haven't put in that time and tightened up on that right side. Well, where do you want to be in the stock? You want to be in the stock over here and waste all this time, or you want to be in the stock right here? And within a number of days, you're up huge on the stock.
This is a good example. This is a good example too, Mark, of where patience pays off. And I remember this name well. I traded this one because if you look at a few of those other areas where it tried to break out, if you bought those, you got rinsed out. To Mark's point, less disciplined traders were laying the groundwork. And I guarantee by the time it sets up properly, a lot of them were gone because they'd already been rinsed out of the stock a few times. And sure enough, it tightens up there on the right-hand side and then just wham, comes out huge.
Going back to what Mark said earlier, you want to be the last weak hand. That's another golden nugget, another $1 million sentence. Again, so here's Green Plains. So come right up you get some demand here right off the lows. Very quickly off the lows, you move right up near the highs. But now you need to tighten up a bit here, right? You look at here's a weekly. I'm just going to move forward a little bit quickly. Kenneth Cole, KCP, this was a stock that I bought. I bought it right over, actually right here as it was breaking out. I bought it right there. But again, you see the nice demand you have here coming off up the right side here. You got some real strong demand here. They had really strong earnings, sales. And again, you can see the market. This is the S&P. The S&P had already been moving here. So this was actually lagging the S&P, but setting up a nice big base. But you're in a bull market here. So I'm going to move on here. Let's see. And actually, we're going to take a break now. We're going to take a break. There's a couple more examples here that you could look at, but I'm giving you a lot of precedents and a lot of charts here. So you have these examples for you to compare and to learn and to burn into your retina, burn into your brain. So when you look at these charts, you're looking for this. It's not important that they're exact. What's important is that you understand the concept and you start looking for volatility contraction. Over time, you'll get the skill, you'll develop the skill to identify these. You'll be able to know what aces and kings look like compared to a pair of threes, or king 3 offsuit. You'll to use a poker analogy, you'll start to be able to identify those, and you'll see what constructive price action looks like versus price action that's more dangerous and risky and volatile. So we're going to take a break, and then we'll come back. When we come back, we're going to talk about what you look for after the stock comes out of these bases, goes through the pivot point, and whether you should hold it for a longer period of time, or if something's wrong and you should be looking to reduce or sell the stock, looking for what I call confirmations and violations. When we come back, we're going to take a break right now, though. Okay. See you guys in a little bit.
Okay, guys, sorry about the interruption, but it was just a minor thing. We do have technical glitches that do occur from time to time that unfortunately did happen with Zoom. But this is going to be a 15-minute break that we'll be taking. I hope you really enjoyed that section. It is really getting into the details that makes this real fun and exciting for the workshop, for me at least. And when we come back, we'll be picking up on natural reactions. So let's take a 15-minute break now. Get up, get some food or jumping jacks or push-ups and get the blood pumping. Speak to you in a few.